Hey guys, Toby Mathis, and we are going to be discussing the difference between a real estate investor and a real estate dealer. So let's dive right on in. Number one, why do we care? What is this dealer and why is it different than an investor? So let's go over what the benefits are of being a real estate investor before defining even what it is. When you are a real estate investor, you get to take depreciation on the real estate that you own. And the easiest way to think about this is whatever is built on your land. So you think of your land and there's a little box on your land that's a piece of property, whether it be residential or non-residential. The IRS says that box has a useful life and lets you take a deduction for a portion of that box over its useful life. The most common is residential at 27.5 years or non-residential at 39 years. Most people are used to that. Most accountants, that's their rule of thumb. You're going to write off 1/27th and a half every year of that property. It doesn't quite work that way because we have the half of the first year it's put into service. They treat it like it was half the year. But you get to write off a portion of that property as a deduction against its income. So if I'm a real estate investor and I have a rental home and that rental home is making $2,000 a month, and at the end of the day, that's $24,000 a year that it's bringing in, I subtract off my property taxes, my insurance, my management fee, my repairs, all my costs associated with that property, and I might have, let's say it's $10,000 of net. Then I get to write off the depreciation. And depending on the value of the home, maybe it's the entire $10,000 and I don't have to pay tax on any of that income because my depreciation offset it. That's a big component of being a real estate investor and why it is so advantageous. You can literally get tax-free income off of your rental properties as a result of that depreciation. For savvy investors, you can actually accelerate that depreciation, and they understand that there's things called cost segregations and bonus depreciation to push a lot of the deduction into the early years and actually create a situation where you don't even have to pay tax on other income that you're receiving because of that property. In fact, I can create a paper loss on my real estate and use it to offset other sources of income, subject to the passive activity loss rules. But if I'm an active participant, I can write off up to $25,000 a year, subject to some income limitations, $150,000. It phases out between $100,000 and $150,000. Or if I'm a real estate professional, there's no such limitation, and I can just use those losses to offset my other types of income, subject to a net business loss rule that restricts, so that if you make $1 million a year, you're not going to be able to offset your entire $1 million from your real estate losses, but it's pretty darn close, right? So that's a huge benefit, is that depreciation. Another benefit of investment real estate is that, and by the way, you cannot depreciate dealer property. This is why there's that distinction really matters. You cannot depreciate all the stuff you did on that dealer property. I'm putting a bunch of improvements and everything else. Don't get it. It just adds to the basis of that property, and I'll go over why that's important. But you lose the depreciation. Number two, another reason why we like real estate investment property is because I can do something called an installment sale on it. If I sell it, I can spread out the gain in the income that I'm receiving and the interest that I'm receiving over many, many years. It's called Section 453. I don't have to recognize it all in the year that I sell. You cannot do that as a dealer. This is another big one. It's like, if a dealer sells a property, even if they're doing an installment sale, which means spreading out the payments over more than one tax year. So let's say I did a 10-year note and I'm getting my money over 10 years. I have to pay tax as though I received the gain on day one. I don't get to, it's not when I receive the money, it's when I sell it, which can be really problematic if you exit a property with an installment sale and all of a sudden you're hit with a huge tax bill. You haven't even received the money yet. You may be in a situation where you're upside down. You can also, if you are in, by the way, you cannot do that with that dealer property. You cannot. So if I'm flipping houses, and I'll get into the definition of a dealer property here sooner than later, so we make sure that we don't get too deep into this. But if I'm flipping houses and I'm doing an installment sales, there's a good chance I'm recognizing those the year that I sell it over and over and over again. And I've seen people absolutely put themselves behind the 8 ball as a result. Other thing I can do if I am a real estate investor is I get to do what's called a 1031 exchange. I can sell one property, buy another property of equal or greater value, or properties of equal or greater value, and I do not have to pay tax on the gain or depreciation recapture. It rolls into the new property. So I can avoid having to have a taxable event if I am a real estate investor by using a 1031 exchange. A dealer cannot. So now let's get into what is a dealer. A dealer is somebody who buys property to sell it. You buy it with the intent to sell that property. How do we know what your intent is? The IRS is really good at looking at crystal balls, and they're like, what was your intent? No, they look at the facts surrounding it. So there are situations where somebody with one piece of property was classified as a dealer. Wait, don't you have, like, that's not fair. I thought that dealers, you had to sell like 5 or 6. Nope. One property, and it was because while he was buying it, he already was negotiating the sale. He was clearly buying that property with the intent to sell it. Somebody's going to say, well, another way to get away from dealer is you hold it for a year. That makes me automatically an investor. No, it does not. There are cases where one case in particular, individual purchased a property. They thought that they were going to fix it up and sell it. The economy shifted, and they ended up keeping that property for 10 years as a rental property. 10 years. When they sold it, what were they? An investor or a dealer? Well, when they bought it, what was their intent? And the IRS was able to look at their intent by saying every year they listed it for sale. Every year they tried to unload that property. The IRS said that individual was a dealer. Here's the other thing with dealers. It is ordinary income subject to self-employment taxes, Social Security, FICA, whatever you want to call it, old age, disability, and survivors and Medicare, 15.3%, plus it's ordinary income. It's absolutely brutal. In other words, ordinary income is your federal tax rate goes up to 37%, and your employment taxes are 15.3%. There's all sorts of phase-outs and add-ons and all this fun stuff. But let me just put it this way. If you sold a property, let's say that you sold a property and you had about $100,000 of profit. You're talking about close to $50,000 in taxes on the dealer property, as opposed to probably closer to 20, 22, 23% on the investment property. In other words, you get much better tax treatment because there's some recapture, guys. Some of you guys are trying to do the math. There's much better tax treatment when you are an investor. And in that particular case, it's quite literally more than twice the tax owed if you were a dealer. So we want to make sure that we are making this exceedingly easy for the IRS to determine whether you are a dealer or an investor. And the way you do this is if you are going to flip houses or you're going to have dealer houses, you're going to buy properties with the intent to sell them. Maybe you're going to buy it, fix it up, rent it out, and sell it as a fix and flip. The IRS is going to look at you and say that's dealer. The more properties you do, the more likely it is that you are a dealer. But here's something interesting. There's actually a case where a gentleman sold 90 properties in 1 year. Let me see if I actually have the case written down. I may have notes on it. Nathan Goldberg built a bunch of houses after World War II, and he sold them all in a particular year. I think that there was something that created his desire to actually sell them. It might have been estate planning. It might have been that, he was just getting old and liquidation. But he sold 90 houses in 1 year. Now, for those of you guys who are out there saying, oh, 5 or more is a dealer. Nope. The IRS correctly said, no, you bought it for a long-term hold. It was investment purpose. You had appreciation, great, but you bought them to rent them, and as a result, you are an investor. You are not a dealer. And again, we can contrast that with the gentleman. There's actually I may even have that case floating around here somewhere. But there was a gentleman who sold one property. Again, he already had negotiated the sale and was classified as a dealer. So we want to make this very easy for the IRS. And the way you do it is you set up an S Corp to minimize the tax hit on your dealer. You could do a C Corp as well, or you could do an LLC. Taxed is either an S Corp or a C Corp. It all depends on your circumstances. There's no cookie cutter here. It just needs to be a corporation or an LLC taxed as a corporation. And you should do your flips within that tax return. Why do I say that tax return? Because you do not want to flip all your properties in one entity. You want to make sure that you have a best practice. You want to have a separate entity per flip. Why would I say that? Because there's liabilities that could come back and bite you 10 years, 15 years, 20 years down the line if you flip a house and if they uncover a defect or something else. You want to make sure that if somebody ever comes after you in your organization, that they're looking at an entity that had been dissolved years ago. Hey, I want to sue this guy. Well, he doesn't exist anymore. It kind of puts a damper on that lawsuit, right? So you want to make sure that at a minimum, make sure that you are isolating it from you so that you have that S Corp or a C Corp or an LLC taxed as either that is separate from you. And the best practice is really to set up an LLC for each flipper, each house, and it's owned by that S Corp or C Corp. So it could be owned. It could be an LLC that's disregarded. It could be a Q sub if these are S corporations. But at the end of the day, you want to make sure that when it comes down to your tax return, it's coming through a business tax return. So if it's an S Corp and it flows onto my 1040, it's going to go onto your page 2 of your Schedule E. It's coming via a tax return that's called an 1120S. You want to make sure the IRS can clearly see that's where you're doing your dealer flips, that's where you're doing your dealer activities. And then you're going to keep your investment properties completely separate. Generally speaking, you want that to flow onto your return via a partnership return. So you might have a Wyoming LLC for asset protection and anonymity purposes. You have it as a holding company, and then you have your properties held in either one or more LLCs in the various states where your investment properties are located. That's another thing. It's a topic for another day. If you want to learn why we're doing that, come to our tax and asset protection workshop. They're absolutely free. There's going to be a link attached here that you can just go register. But if you want to learn about LLCs and land trusts and corporations and how they work for real estate investing, I encourage you. It's a one-day class that you're going to learn a ton by attending, but you'll understand why. But we're isolating those two on our tax return so the IRS clearly knows this is my dealer, this is my investment activity. I'm keeping them separate. I'm clearly delineating them so that they don't get the urge to start going after your investment properties and make them dealer. What could happen, and they're supposed to go property by property, but it's facts and circumstances. If they see a couple of flips and a couple of investments, they may just say, you're buying all those properties to sell. You're just holding on to some of these and you're waiting for the best price because clearly you like to sell your properties. But again, there's a lot of bad information out there. Hold it for a year and you avoid dealer status. That's bunk. That's absolutely false. Hey, I'm flipping houses and I can do the installment sale. No, you can't. If you get audited on that, you're going to see some very significant penalties and it's going to be devastating to your business. You don't want to do that. The easiest way that I tell people to visualize this is if you're a dealer, it's no different than a car dealership. You're buying your houses and you're putting them on a car lot. Some of those cars take a week to sell, a day to sell. Some of them take 2 years to sell. You don't know. You're looking around, you're waiting for your customer. What we know is you have a car on a car lot and you don't get to depreciate them. When you do sell it, it's active income. So we want to shelter that by using an S Corp or a C Corp, depending on your situation. It's going to vary. But you want to make sure that you're not getting a massive tax hit as a result of your activities doing a dealer. But we want to make clear, here's my car lot, and then here's all my investment properties over here. Like everything's, we're keeping them clearly separate so that the IRS doesn't get confused and decide to take all of your properties and stick it on the car lot, right? That could be devastating from a tax standpoint. So we want to avoid that if all humanly possible. All right, guys, if you need to talk to somebody, if this triggered some things in you and you're like, oh my gosh, I'm now confused about my situation, do not worry. We will absolutely meet with you for free and help you unravel that. All you have to do is put down below in the comment section, strategy. If you write in the word strategy, you can meet with one of our attorneys or one of our advisors. They will look at your situation. They will help you unravel whether you are a dealer or an investor in the proper way to actually structure it. It's a free strategy session that if you want it, it's yours. All you have to do is down below write strategy. If you are willing to, please click that thumbs up and for liking it and subscribe to our channel. And if you know of anybody that could benefit from this information, by all means, please share it with them. Just forward it on and invite them onto our site. It's absolutely free. And good luck to you in your real estate investing.